Hello, everybody. Welcome to our GAF webinar today. Today's series is going to focus on loans and CARES during this really difficult time. This is the second of a series to our session. So thank you, everybody, for joining. What we're going to cover today is I'm thrilled to have Dana Rosen with us. She has a significant background in loan mortgage, so we're excited to have her. Let me just give you some housekeeping tips for today. We've got everybody muted. When you have questions, submit the questions through the Q&A box. That's part of the Zoom experience. We will go through some of the questions toward the end of the call. So Dana has prepared a presentation. We'll probably cover about 20 to 30 minutes of her pre-designed presentation. Then we will go open up to the Q&A. And if there isn't too many questions, then we also have additional material that we'd be happy to share with you. I'll do a quick intro on Dana. Dana has 13 years experience in the financial industry, specifically working with small businesses and loans in the loan space. She actually has much broader experience in financial services, but specifically 13 years in this space. Additionally, she has actually run a portfolio of over 300 small business, managed 300 small businesses for BB&T for several years. And these small business owners were typically looking for loans and having loans in the $1 to $5 million space. So she really understands the small business arena. So with this introduction and foundation, I really want to give most of the time over to Dana. I assure you, your questions and how you think about your business are super important to us. So go ahead and continue to submit your questions through the Q&A box, and we will get to those during the Q&A session. Over to you, Dana.
Thank you so much, Jean and Steve. I'd like to say thank you to everybody out there joining us today. Really appreciate you making the time, and I want to make sure this is very valuable to you all. Let's jump right into it. We're looking at our first overview of common loan options for businesses. And well, the CARES Act isn't common at all, but it is new, and it's causing a lot of confusion for a lot of people. It's very different than your typical SBA programs, and we're going to cover that today. So, one overview of the SBA CARES Act. I understand in the previous webinar, you had some opportunity to learn about it, and the EIDL, which is the Economic Industry Disaster Loan. We'll cover that really briefly. And we're going to go into SBA programs, mostly the 7A, then some other vehicles at which business owners can utilize to acquire financing and bridge loans, and some information on supply chain loan options. So on our first slide, so a lot of you have seen, and again, I'm not going to talk about this a lot, but just to give you some context, the EIDL, the Economic Industry Disaster Loan, this was, rolled out to help the business owners during this pandemic. This is something that you apply directly through the SBA. You do not need a lender to do this. And so, these are advances up to $10,000. Funds are typically made available within a few days. These loan advances of $10,000 up to $10,000 do not need to be repaid. And again, you must apply directly through the SBA. So the next slide, we're going to go on to everybody's favorite topic these days is the Paycheck Protection Program. So who's this for typically? It's for all businesses, nonprofits. They're extending it to, tribal organizations and veterans businesses. But typically it's with 500 employees or less, and they can have multiple locations. So typically this is being offered to help you as business owners retain your staff, retain the people that you had to lay off or furlough as a result of this pandemic. And this is really uncomfortable for everybody, I know. And everybody would love to, take advantage of this program. So as of February 15th, 2020, any business that had employees, this is who it's for. And your average monthly payroll costs have to be verified for that. And there's a process to that. Sole proprietors, independent contractors, and self-employed persons are also eligible to apply at different dates. So unlike the SBA program, and this is part of what's causing a little confusion about it, is there are no personal guarantees for this program, and there's no collateral requirement for this program. It is a forgivable grant, they're calling it. But it's only forgivable if we follow the guidelines. And some of these guidelines I'm going to lay out for you a little bit here. What's really important to be checks and balances throughout this process is that when you're talking about what portion is forgivable, we want to make sure that when you receive the monies after applying, that 75% of the money that you are receiving for this must go towards payroll, meaning you want to retain those employees back. It can go towards payroll, towards their benefits, if you had any severance, and a lot of different details in between. But that's essentially what they want you to use 75% of these funds for. And then 25% of those funds may be used to pay rent, pay your mortgage, pay some utility bills. And I just want to highlight, it's really important for people taking advantage of this program. A couple little suggestion on my part is anybody who has applied, who receives money, I would open up a separate business account and put those government funds in that account. And the reason I suggest doing this is because you don't want to commingle the funds that are yours, that you're managing, and you want to keep those funds separate. And the reason you want to do that is it just makes it a lot less confusing when you're going through the audit. And I'll call it an audit because the government's going to audit these in the sense that they're going to check to make sure that 75% was used for payroll and 25% of that money was used for mortgages and utilities. So if 26% got used for the other and 74, then that loan is not going to be forgivable. And I share this so that you have an awareness and you can be forearmed and forewarned. So let's see here. So these loans again can be used for borrowers who are eligible can use these proceeds again for payroll costs. That includes benefits, interest on mortgage obligations that were incurred before February 15th, rent under lease agreements that were in force before February 15th. So February 15th is really the date. And so if anybody wants to know what counts as payroll costs, so I suppose we could cover that, but I'm not sure that that's something we need to go into right this second. Maybe we could save that for the Q&A, but I can happy to, talk about that. I think a lot of you know that we are capped at $100,000. So if you have an employee that is earning $100,000 or more, they are not eligible to be considered. However, if you were to have laid off somebody with $100,000 and then you had to furlough them and then you retained them, you can retain them and then you can reduce their salary, but not more than 25%. Again, these are little details that are all really found on a borrower's fact sheet that I'm happy to share. It's also on the SBA site. I don't want to confuse you with all these details, but I just want to make you aware that everybody who wants to participate with the PPP program, just, read the fine print on those details. So I'm going to go on to SBA loans and talk a little bit, and you're going to see how an SBA loan is a lot different than the PPP program. So SBA 7A loans, there are two different types of SBA loans. Typically there's a 7A and there's the 504. I am not going into the 504 today. I really want to focus on the 7A because I feel like this is where might make more sense for you folks. With a 7A loan, so as most government guaranteed loans, these are full of requirements and little details and little rules. And that's why you want to count on a lender who's a preferred SBA lender. which basically means a lot of banks have designations, and if they are to offer SBA loans, and the designation that the bank receives is a preferred lender status. Not all banks have this, so it's important to ask your lender, your financial institution, and also know that there's non-banks out there who lend, who are preferred lenders. For example, I represent a company that's not a bank that is an SBA preferred lender. So your options are, you can go to a bank, you can go to a non-bank, but you just want to make sure that they're a direct SBA lender. So these loans, the difference really between an SBA loan and your typical conventional is that the SBA loan is partially guaranteed by the government. And this gives a lender a lot more freedom and willingness to lend. Because of this, SBA loans typically have higher amounts and lower interest rates and longer repayment terms. So these are some of the benefits. And the options that you have, you can purchase, you can refinance using an SBA loan. I will say, again, there's little rules here and there. For example, here's a little one. You can't refinance an SBA loan with an SBA loan. But if you have a conventional loan or a bridge loan, you can convert that to an SBA loan. So for businesses, this is typically SBA 7A loans for business acquisition, for expansion, you can purchase. And typically there's an owner-occupied ruling. So you need to make sure that you occupy the business space, whether you lease or you own, 51% or more. That's a hard and fast SBA rule. These SBA loans go up to 5 million. And there are smaller express loans that you can get for working capital that are much smaller, that you can get from about 50,000. In some cases, depending on the lender, I put 150,000, but I have seen other lenders that would go up to 250. So now typically the minimum credit FICO for an SBA loan, according to the SBA, is 680. But again, some lenders have the ability to be more flexible if they wish. So I have seen that number at 650. Now, unlike the CARES Act, a personal guarantee is required for the 7A loan, and you will require collateral. Now, the collateral could be commercial real estate. It could be inventory, furniture, fixtures, and equipment. So that's what FF&E is. So you have some options as a business owner, and depending on what you have, that will determine the leverage, the loan to value, all the other little details, because at the end of the day, these loans have certain criteria, but each business owner will have different things to bring to the table. So if you are a business owner with commercial real estate, or if you're a business owner that doesn't have commercial real estate, there are different vehicles and tools that you can use these SBA loans for. And you'll want to really lean on your lender to help you, because I wouldn't expect you to be an expert on this by the time we're finished this dialogue. So interest rates on SBA loans, it's always based on prime and plus 2.75. Now right now, prime's really low. Prime's at 3.25, which is great for people who want to take advantage of this. That's a pretty low rate for the SBA loan. And depending on the credit quality and the collateral, will depend on whether or not you could be prime plus 2% or prime plus 2.75 or anywhere in between. Now, SBA loans, one of the great advantages to business owners is the ability to purchase an asset at a very high leverage or a high loan to value. What this really means for you as a business owner is if you wish to purchase an asset, let's say you want to purchase a second location, just using this as an example, then you could purchase it using an SBA loan, and you could get up to 90% loan to value. So what does this mean to you as a borrower? This means that you will only have to put down 10%. In some cases, it can go up to 93% loan to value. And you typically can finance those closing costs into the loan. So it doesn't have to feel really stressed out about, thank you. It doesn't have to feel stressed out about those closing costs because they can be financed. So typically you have about a 25-year term. And again, you're looking at 85 to 90% loan to value and owner's equity into it about 10 to 15%. Again, depending. If you have an SBA loan and you own a property and your loan to value is much lower, that only mitigates the risk for you and for the lender. So there's more wiggle room there. Oh, and I should also mention with SBA 7A loans, if you're using a bank that is a preferred lender or a non-bank, there is only one layer of approval. I'm not going into the 504 loan, but I will tell you that the 504 loan requires 3 levels of approval: the lender, the SBA, and the CDC, which is the Certified Development Company. Don't even worry about that. Just know that the 7A loan is a really great vehicle to leverage. 1 layer of approval. So, because if you were to be declined by any of the 3 in that other process, you can't reapply for 6 months. Again, tiny little rules that come into play. So, and we'll move on to the next slide. All right, so I will tell you, it's funny. I'm actually working with a roofer right now, a roofer in California. I'm working with him. I want you to know I understand your industry. I understand what you guys are doing, and I want to thank you all for being an essential business and being out there during this crazy pandemic. Working with a business owner now who's a roofer, and we started working together before this pandemic hit. We started working together in December of last year to help him get a conventional loan. He was refinancing a bridge loan. See, we came to the bridge financing, so I just wanted to bring this up. This business owner was refinancing a bridge loan, and we were going to go conventional. But then the pandemic hit, and all of a sudden, a lot of things were changing. A lot of different institutions stopped doing certain types of loans, and that was not a viable place to go forward with him. So what did we do? We said, well, you know what? Let's make this into an SBA 7A loan instead. And by doing so, I was able to actually, get him a lesser rate, and, just the ability to be able to pivot in this crazy time that we're living in is really important, to be flexible as to because everything keeps changing by the day. I share that story with you so you understand a couple things. Number one, dealing with a business owner, and then we had a plan, and then that plan had to be changed. And we're able to change, and we're able to pivot, and we're able to make concessions. So with the bridge financing, which we're going into now, so this is just a short-term loan, typically an interest-only loan. If you have an asset, a piece of real estate, commercial, that is in a transition of sorts, a bridge loan is a really great product to put short-term financing on, and sort of can allow that asset to complete whatever transition it's going through. To give you an example, you could be a business owner with a great asset, but perhaps the bridge that connected half of a lot of the community to you got closed. I've seen this happen before, by the way. That bridge gets closed. So all of a sudden, all those folks who were trying to get to your venue can't get there. And they've got to find a different way to go. And a lot of times, it's just one example. If there's construction going on and people can't reach where you are, and perhaps that's going to affect your cash flow, perhaps that's going to affect things. Maybe you're going to need a bridge loan for something like that in the meantime. So again, short-term loan, it's used until permanent financing can be secured. It can be used on a variety of asset types. And it's interesting, putting this together, one of those asset types was hospitality and flag hotels. But here we are in a pandemic, and it's pencils down on hotels right now. So, I didn't add that into the list of types of loans that they can do, types of assets. You won't see that. Hotels right now are just on pause, and it's a shame for those folks in hospitality. It can be very difficult right now. So, but typically you're looking at multifamily, office, industrial, self-storage. A lot of times they're case by case, which I put for specialty, retail, land, and mixed use. Loans are typically larger. You're looking at maybe a minimum of 2 million, maximum of 24. Give or take, though, because it really, oftentimes, especially in this environment, it can depend on on your deal, on your scenario, and what you have to bring to the table. Every borrower's risk and reward is different. Everybody has something different to offer. Everybody has different credit metrics. Everybody's dealing in a different realm. Everybody's business is just unique. Even if you're in the same industry, there's little changes and differences within all businesses. So again, typically these bridge loans are interest only, and the fees, there's origination fees, and they will range from about 1.5% to 3%. Again, non-recourse, no personal guarantees are typically required. However, if there's a high risk type of a deal and the borrower and the lender still willing to lend, they might require some partial guarantees. All this to say, again, it's all very custom made, these programs, but just wanted to kind of give you a skeleton for what they are. These are sort of the bones. Rates typically around 7.5 interest only and up, again, depending on the asset type and the credit risk. Okay, so we're going to move on to another way of getting money faster when some of the other routes aren't available. And it's called the merchant cash advance, also known as factoring or purchase order lending. So, you know, this is a type of finance that business which will sell its accounts receivables or its invoices to a third party, known as a factor, and at a discount, they'll be able to get their money to use right away. Here's some differences with this. Unlike the banks and the lenders, this is not credit driven. So you know, it's like, what makes more sense for you? Maybe you're not in a position to go to a bank, and not every business is. Banks have a very tight credit box, and you really need to fit into that box or you just don't fit. And there are products in between. This is just an example of something that a lot of business owners take advantage of in order to get some working capital. So again, it's not credit driven or report to credit agencies, and it's a pretty fast turnaround. All you really need in order to apply for something like this are 3 months of recent bank statements, a work in progress report or a WIP report, as I'm sure you're familiar with, and that you need to be about 1 year in business. So you can typically get up to 5 million unsecured, no collateral, no PGs, right? And these are up to 12 months, and you can figure out whether or not you want to pay this back in a daily, a weekly, or a bi-weekly process. So that's, again, that's going to depend on each business owner. And these are typically based on 10 to 15% of your annual revenue. So again, it's not going to actually go into what you typically will need to provide a lender. But if you're looking at this, you can see you're only being asked for 3 things, not even 2 things. You need to be a year in business, but the only physical documentation you need to bring to the table are your bank statements and your work in progress report. So, and then they usually receive, a business owner will usually receive funding within 24 hours after that's all, the process is complete. So, now, given the pandemic that we are in, there are a lot of other companies that have come up with creative ways to offer financing. So one of the programs this is a private lending institution that is rolling out something they're calling their COVID-19 Relief Bridge Loan Program. I'm showing this to you because this is not a government program. This is an opportunity for a business owner to take advantage of getting access to cash using their commercial real estate or residential real estate. And this is a really great option if you don't have a lot of things to offer. Let's say you don't own a commercial piece of real estate, but you own residential real estate. Some of it might be maybe it's a vacation home that you lease out. It doesn't really matter. If you own real estate in your name and it's residential, it's commercial, you can use the equity in those properties to secure yourself some financing. So these loans in particular, 50,000 to 2 million, that's about the loan size, and these are secured by the real estate collateral, residential or commercial. They'll use the equity in these properties to forward you the cash. Think of it as a cash out refinance, but you're just pulling the cash out of your property, which isn't always that easy to do with a lot of hoop jumping, I will say. These are short-term, again, up to 2 years, 24 months, with payment options that you can create. Do you want to pay it daily? Do you want to pay it weekly? These are your options. All that is required to apply for this loan is 6 months of bank statements, schedule of real estate owned, SREO, and a one-page application. And by the way, for this program, because they're using real estate to secure it, as you can see, they don't have high credit minimum, their high credit needs. So you can have a 500 credit score if that's the case. You know, people have credit scores all over the place, and sometimes it's not because they don't manage their credit. There are the other issues behind the scenes, and sometimes you don't have the time to correct those credit issues in order to fit into the box that a typical bank would want you to. So just another option for you to show. There's a lot of programs out there. And this program in particular, I would like to mention that they're not even going to consider looking at any financial bank statements prior to this pandemic hitting. I would say maybe around February 15th, probably, because they understand every business is being affected. So with that, I want to go on to share with you typically what you would need as a business owner to compile. What do you want to get together for most loans? Of course, those two other short-term cash loans that don't require the credit, you're not going to need all of this. But for an SBA loan or a typical bank loan, this is essentially what you'll need. They'll provide you with an application. You're typically going to need your last 3 years personal tax returns, last 3 years corporate tax returns, real estate holding returns. Now look, if you're a subchapter S and you flow your taxes flow through your personal, then we'll use your personal, but essentially they want to see the tax returns. If you're purchasing a business and an asset, they might want to see the tax returns of the business that you're purchasing to show that that business has the cash flow to service the debt moving forward. So you'll also need to show interim financial statements to year to date. So profit and loss, a balance sheet within the last 90 days. These don't necessarily have to be CPA certified, just so you know. They can be, but they don't need to be. So if this is a purchase acquisition, you're going to need a copy of your agreement of sale or the purchase contract. And if you're refinancing it, then you're going to need a copy of that note that we're refinancing, the one that we're going to be paying off. Now, aside from that, we're going to need a copy of a business debt schedule, and typically a lender will provide that to you. I often provide that to my clients. Now, if this is an SBA loan, it's going to be a couple other documents. I didn't list them in here because it's really for us to provide to you, and I wouldn't want you to think, oh my gosh, I don't have that form. It's okay. It's not on this list for that reason. It's up to your lender to provide that to you. So if it was an SBA loan, there's a form called the 1919. There's also a tax form called the 4506T form. Didn't put it in here because I don't want you to worry about it. That's something your bank will tell you about. So this is the list of items that you will typically need to provide for a loan.
Thanks, Dana.
And, yeah.
Can you hear me?
Yes.
So this is the portion that we've prepared. As you've been going through everything, we actually have had a number of questions. So let me go through one or two of the categories where we've had fewer questions, and then we'll go to the area where we had the majority of questions, if that's okay.
Yes.
But folks who are attending, feel free to keep continuing to submit the questions as you've got them. First, there were a couple of questions asking about the non-SBA and the non-CARES loans. There were some questions around the merchant cash advance. So the first question there was, when you think about the merchant cash advance, is the cost to return, is that a more expensive kind of loan than some of the other loans that were earlier in the call?
Yes. So the answer to that is yes. And to that I say, sometimes the access to cash is more valuable than the cost of it. Because oftentimes you can pay it back really fast. If you need to access that cash, it might cost a little more. Once you access it, you can, and then you were able to do the transaction that you needed that cash to do, then you can pay it back. So it is definitely more expensive than your typical loans. So yeah.
Okay, and so just in case, so some of the kinds of companies that use that merchant cash advance could be a clothing manufacturer, right? So that person has to buy materials to create all these clothes that they're going to ship out to the stores, and then only after the stores have received them does that company get back. That's kind of one of the scenarios that uses that. Another question in that space was, do you only pay back the amount you borrowed in the merchant cash advance, and what is the interest?
So the interest is going to vary, but it's typically based, well, again, it's definitely going to vary. I can't quote a specific rate, but I've seen it from 15% to 30%. I have. Depends on who you access that from.
Yeah.
And yeah, it really depends. Again, I give this sort of as a blanket of what's available, but as I mentioned before, each business owner has different scenarios. You've got different purchase orders or different incoming, accounts receivable. Based on that, that's, and also let's say you've got really good credit versus somebody who doesn't. Your rate may vary based on those criteria as well.
Great. Then the next question's in around the SBA loans that are not care related.
Yes.
You started talking about some of the SBA loan options. You talked about something along the ideas of, can you use some of the loans? I think you talked about consolidating balances across higher interest rate loans. So if I have an auto loan, could I convert an auto loan into an SBA loan?
There could be a case to be made where you could do a debt consolidation of a lot of things. So yes, I believe that you could use that vehicle. I mean, by vehicle, I mean the SBA loan vehicle. But yes, if you wanted to take a bunch of different debt that's sort of scattered and consolidate it, there could be a possibility that you could put that into an SBA loan. But again, it's going to just depend. I think there's a scenario where you can do a debt consolidation, if that's the question that you're asking.
Yes. Okay, so all the rest of the questions that came in were very much around the CARES payroll protection plan. And I think that's not a surprise given
No.
how challenging it can be to navigate it. So
it's been.
No, there are some pieces of it that really are very detailed. And that's actually why we want to have you here. So given that we have the extra time, let's go through some of the details.
Let's.
In the roofing industry, we've got a variety of companies, right? Companies who have 1099 employees, W-2, subcontractors, the owner of the employee. How do you calculate payroll? And do I calculate healthcare benefits? Can I add those other things on top of the wages and the commissions from the salespeople? Which ones can be included? Which ones should not?
Okay, so with regards to, just so I understand your question, what's included is really the question, and what counts as payroll cost?
Yes.
Okay.
Yes. What counts as payroll cost?
So
knowing that people here have 1099 employees, W-2, the owner, like as an owner, can I take out the payroll protection loan to cover myself? And when I'm calculating wages, do benefits such as health insurance, does that count?
Okay, great. So I can tell you that the 1099 employees, I believe, need to apply on their own as independent contractors. But what counts as payroll costs would be your salary, your wages, commissions, or tips. And this again is capped at 100,000. So employee benefits
employee that you submit.
For an employee that you submit. Right?
So if you have 10 employees, who are making $100,000 or less, it's 100,000 times 10. If all my employees are making well over $100,000, it's still 100,000 per employee.
Yeah, it has to be just under
It's capped
100,000.
at 100,000 per
Yes.
employee.
So it's capped at 100. So it includes salary, wages, commissions, or tips, annualized, and so capped at 100,000 annual on an annualized basis for each employee. So it will include employee benefits, including costs for vacation, parental, family, and medical or sick leave, and allowances for separation or dismissal if you had to, let somebody go. And these payments required for the provisions of group and healthcare. So yes, it'll help you with that. If you're covering the cost of your employees' healthcare, that can be included in it as well. And your insurance premiums for that also are included, and in payments for any sort of retirement benefit, and state and local taxes assessed on the compensation. So for sole proprietors and independent contractors, wages, commissions, incomes, and net earnings from self-employment, again, capped at 100,000. And this is all on an annualized basis per employee.
What if I happen to have many employees? Is there a maximum loan that I can get from payroll protection?
The maximum loan amount
Yes.
is 10 million.
Okay.
That's the maximum loan amount that a business owner can receive based on the application to the CARES program, the PPP.
There's a lot of people who talk about the CARES Act, talk about this forgiveness.
Yes.
What does that mean? Does that mean I don't have to pay it back?
Yeah. Let's talk about forgiveness. Yes. Forgiveness would mean that you would not, business owner, have to pay this back if you jumped specifically through the hoops that they're asking you to. So you would apply, you would provide, and it would be for these 8 weeks, I believe, starting anything that started on, I believe it's February 15th of 2020, and then 8 weeks. And the purpose of them giving you this money and the reason it's forgivable is because by doing so, you're going to rehire your employees, keep them employed, and you're stimulating the economy when you're doing that as well. So the government and the SBA and the Treasury are counting on you to use this money for those purposes. And that's why I mentioned the 75%, 25% buckets. So part of that is that it's forgivable so long as you use 75% of the funds that they give you. So you apply, you're approved, right? You get your money. Again, I'd open up a separate bank account, take that government money, put it in that account. And the only reason I'm saying to do this is that you will never have to say to the government, no, that was part of my money in the account. You don't want to have to do that. You separate the funds, you don't want to commingle them. And then you can make sure that the funds that they gave you after applying and you were approved and they disperse those funds into your bank account, transfer them into a new account, 75% of those funds will need to be used to hire employees and all of those services, the salary, the wages, the commission, the tips, the severance, the benefits, all of that stuff, that 75% bucket goes towards that. And the 25% you can use to pay bills, utilities, mortgages. Just be super careful about the 25-75 rule, because the reason these loans will be forgiven is that you followed those rules. The fact that they're not asking for collateral or personal guarantees is a great advantage to you as business owners. And you just want to show your work, basically. So you'll get the money and you just want to make sure that you separate 75%, 25%, and you use that allocation as indicated and instructed by the SBA CARES Act. I hope I answered your question.
So then when you set up that separate account, would you recommend then that's how you're going to draw down from that account when you're paying your employees to show that it's the 75%? I
would definitely, you just want to really keep track of everything. So you get the lump sum in, do your own math as to, okay, what's 25% of this? And that's a bucket that you'll know that you need to, that amount will be allocated towards your bills and your utilities. And that 75% will allow you to rehire employees, keep them on payroll, get their health benefits, and you're stimulating the economy by doing so, and you're following the rules.
So do you think, so questions about the PPP, payroll protection plan.
Yes.
So the foundation of applying for the payroll protection plan is either the owner's salary or employee payroll. So I probably can I count things like rent or utilities when I'm applying for it? And I think you said that I could use some of the money that I draw down for non-payroll expenses. But do I count rent and utilities when I'm submitting for the payroll protection plan or no?
So, I think that might be, I think you can.
But it's
I
audited.
know that they're counting it as payroll costs, and I know that they're counting that bucket to be 25% to be used for that. So I believe
Just
that
want
they,
to be really clear if you don't want to pay it back. You need to really watch those details.
you really do. And I'm just sort of sharing out there that there's been a lot of confusion about this program, most of which is how to apply and how to access the money. But it just that 75-25 is really important. I do think at this point, and I can share, and they might even have some borrower facts on what's going on. I can share this with Jean afterwards if you want to distribute it to the group, that can sort of detail a lot of these distinctions.
I think you made a good point earlier, which is at the end of the day, when applying and before you take the loan, read the fine print with your CPA or your banker before you, because you don't want to get in trouble. So you mentioned that by taking down the payroll protection plan, that everyone should expect that they may be audited. Would that be just how the money's spent, or do you think it'll be a broader audit?
No, yeah, and that's why I don't want you to be scared when I say audit, because I think that when I say audit, what I mean is your work's going to be checked. So they're going to make sure that you have a business, that you have these employees, that you use this money 25% for this and 75% for your employees. So they just are going to check your work, and they're going to make sure, because anybody who applies for this fraudulently, obviously they need to hold accountable. So there will be federal prosecution charges for people that abuse this option as business owners. And you know, most everybody out there isn't going to do that, but we know that there's a handful of people out there that maybe might take advantage of things like this. We see this around tax time, you know, TurboTax, and people saying, be careful, you know, it's no different. It's another opportunity for, unfortunately, predators to go out there and try to take advantage of business owners like ourselves. So just, you know,
Yeah.
You know.
So we've got a couple more questions about how to calculate the loan amount that you're going to ask for. So if some of these are more a CPA question that are outside of your realm, go ahead and say, you know, you're going to have to check with your accountant.
Okay.
That you've got, go ahead. But, you know, if they're outside of your realm, go ahead and say so. So again, you said that 1099 contractors, independent contractors, needed to apply separately on their own. So if I'm a company that has owners that are listed as W-2 employees, those owner can be counted in the payroll protection loan, yes?
Yes. And the independent contractors and the self-employed individuals, actually today is the date that they can apply.
Great. So and independent contractors, would you consider a sole proprietor an LLC?
Yeah.
Okay, great. And then, you know, roofing is a seasonal business.
Yeah.
Does that mean I have to have that person on the books for 12 months? Does the payroll amount has to be consistent for 12 months, or is it a annualized number? How do you think about payroll when, right? I mean, at the end of the day, roofing is seasonal.
Yeah, it is seasonal, unless you are in like California where it's always the season, right? Or somewhere where it's always nice out. But yeah, I can appreciate that it would be seasonal. I think they really want to look at what were your payroll expenses. You know, you could kind of look at what were they last year in order to figure out maybe what they will look like. But you know, this is really just giving you from, you know, I think it's from February 15th, 8 weeks out. And that's what you're being, that's the loan or grant that's forgivable that you're going to be offered based on applying for this. So it's really 8 weeks of pay. I have a feeling there's going to be more programs following this for business owners, because I don't know that this lifeline is going to be enough for everybody, but it's a great start.
Okay. And then you mentioned some of the things that went into calculating payroll and the related benefits. So there, you know, a lot of owners cover liability and workers' compensation insurance. Would you also count that as a cost when calculating payroll? Or is that a CPA question?
I think that would be, I would feel more comfortable if we all talk to our CPAs about those specific details. I wouldn't want to steer anybody wrong on that one. But again, as the SBA and the Treasury has expressed, these include salary, wages, commissions, tips, vacation time, sick leave, parental, family, medical, separation and dismissal, and provisions under group healthcare benefits, also insurance premiums. So if you can count those, payment of any retirement benefits, and state and local taxes too. So to me, it would seem like you could, but
Okay.
you know, let's just be extra careful here, you know, and dot I's and cross T's. And just, I would check with your CPA.
Okay. So we only have 10 more minutes. So I wanted to make sure we had time to, you know, talk about the company that you represent as and the work that you do as a loan broker. Do you want to share your contact details with the team?
Oh, certainly, absolutely.
So we'll shift into this part. So you mentioned for some things, people need to apply directly to the SBA.
Yes.
In other cases, you said you may want to go to your existing bank, but I think I've been hearing that the large banks have been pretty slow to move. And you also mentioned non-bank lending.
Yeah.
Bank lending in addition to potentially working through you.
Yeah, let's talk about that. It's a really interesting thing. So look, the large majority of my career was working for large publicly traded financial institutions, banks. And presently I'm representing a non-bank SBA direct preferred lender. So now, not all banks are alike. Your options as business owners, you know, there's small community banks, there's credit unions, and there's, you know, non-bank lenders. So where I differentiate myself from a bank, and it really has been hard, by the way, for you business owners. This program rolled out for everybody to apply last Friday, and it really wasn't clear to everybody how to go about this. And I don't think the banks were clear. It was like taking this huge, really important loan and like rushing it out the door. So I think there was a lot going on behind the scenes to get everything and structure everything in place for you business owners to apply. And I'm sure a handful of you, if not a majority of you, went to your existing bank and they either said, A, we don't know if we're doing it, we might be doing it, we are doing it, and it's probably a handful of different experiences out there. So just to let you know, now Harvest is a non-bank private SBA preferred lender. There's 14 designations of SBA preferred lending platforms. I say that is, so to be able to offer SBA, you need to be a preferred lender. If you're not, it can just take a very excruciating amount of time for a business owner to get all the advantages of an SBA loan or even access the PPP CARES Act. So with a non-bank, so for me, if anybody were to want to, you know, get a loan through my company, we're not a bank. So what does this really mean for you? It means we'll help you refinance or purchase an asset, and you don't have to move your banking relationship. You don't have to open up any accounts. You don't have to jump through those hoops. As a former, you know, commercial banking officer, that's a requirement. And that can be a very painful requirement if you need a loan. But Mr. Business Owner, I can only book that loan if you open up your accounts and you move all your main accounts to me. That's not always an easy thing to do. It's not an easy thing to do. It's complicated, and you're busy working on roofs and working your jobs and earning money. So the advantages of working with a non-bank lender are less hoop jumping, typically relaxed credit policy standards. It's not to say they don't have credit policies, they don't mind if maybe you had a bankruptcy in your past, or maybe you had a hardship that you had to go through, whereas banks are going to be less forgiving. So, it's been such a pleasure to work for a non-bank lender of the SBA as opposed to a bank. And I certainly love working for banks, but I also felt that I couldn't always help the business owners that really needed it due to credit policy requirements. So you business owners have choices out there, and there are a ton of private non-bank lenders, and only 14 of them that are SBA designated lenders. So Harvest is an SBA preferred lender, and we're probably rolling out the CARES program, and just like all the other banks are figuring out the infrastructure behind the scenes in order to offer this to clients. And you've probably seen a little bit this week. It's trickled here, it's trickled there. This bank is now able to do it, and it's just been it's been a lot of behind the scenes work to offer this to the clients. So, here's my contact info, and, I certainly welcome anybody who needs guidance or advice. I'm happy to help my communities and beyond. But, it really is an honor to be able to speak with you all today, even though I can't see any of you. I just wanted to say it's such an honor to be able to help the communities out there, especially during this time. I've always felt that way, even not during a pandemic. And, it's my honor to service you and to help you guys accomplish what you need to. But during these really uncertain times, I want to thank you all for being essential workers in what you're doing, and putting yourselves out there to help people with their homes and their assets. So, and whatever I can do to be of service and help you, that's what I'm here for.
Dana, thank you very much for coming today. For the folks on the phone, this has been a series of experts that we've invited to speak in this space. We had a CPA earlier this week. We've got Dana, who really understands the loan business as well as bank lending and non-bank lending. Please go back to the CARES page, so that our GAF training page, so that you can register for additional trainings or access the webinar in the coming weeks. We've also got some additional new speakers coming next week from a legal perspective, contracts perspective. And I think the conversation today really highlighted for me that in navigating the loan space, you may also want to pull in your accountant in the conversation, both for the application process as well as how you manage the money, so that you don't have any surprises in terms of how you might any kind of fees or processing when this period is over. Thank you very much.
I just want to add one thing so that everybody is aware. No matter where you go for the CARES Act, the terms should be the same. The rate should be the same. Everything should be the same. So again, they can't shop you, is what I'm trying to,
That's great news.
Yeah, I'm sorry I didn't mention that before. Everywhere you go, the rate will be the same.
Good. That's really great. And then I'm going to have Steve run a quick poll. We're going to try to get this webinar out, the recording out to folks. Give us some time. The team is really trying to pull a lot of great events together for you. Steve, can you run our poll? I really am hoping that folks that are still on the phone will take time to give us our feedback. This is a new series for GAF. We haven't done this space before, so we really love your time. So I think it says that we can, great, thank you. So please go to the training seminar page and sign up for future webinars. I want to thank you, Dana, for being here. You've been a marvelous guest.
My pleasure.
And who would like to get in touch with Dana for her support navigating the loan experience, she's shared her contact details. So thanks so much.
Thank you. Thank you so much. My pleasure. Absolutely. Be safe out there, everyone.